When global markets shake, investors start looking for safety. Recently, stock markets from London to Tokyo have shown signs of stress. Japan's Nikkei 225 dropped more than 2%, and the U.S. benchmark S&P 500 has also slipped as geopolitical tensions rise. During times like these, money often moves away from risky assets and into so-called safe havens. The first asset most people think of is gold. For decades, gold has been considered a store of value during crises. When uncertainty rises, whether due to war, inflation, or financial instability, investors buy gold to protect their wealth. As demand increases, gold prices often climb, making it one of the most reliable hedges during market turbulence. But gold is not the only safe haven. The U.S. dollar, often called the greenback, frequently strengthens during global instability. This may seem surprising, especially when the crisis originates outside the United States. However, the U.S. financial system is still seen as one of the most stable and liquid in the world. As investors sell risky assets globally, they often move capital into dollar-denominated assets, such as U.S. Treasury bonds. This demand pushes the dollar higher, creating a natural hedge against falling equity markets. Another asset gaining attention is silver. Silver tends to follow gold during crises, but it behaves slightly differently because it also has strong industrial demand. When investors rush to safety, silver prices can rise alongside gold, although often with more volatility. The key lesson for investors is simple. In times of global uncertainty, diversification becomes crucial. Gold, the U.S. dollar, and even silver can act as protective shields when stock markets decline. The smartest strategy is not relying on a single safe haven, but understanding how different assets react when fear enters the financial markets.